So let's start with individual sectors, and then we'll go to the market, because you think semiconductors are working.
The big thing that's working in the market right now is semiconductors. I mean, they are making all-time highs, despite the fact that the month-over-month or even year-over-year sales of semiconductors are still slowing. So one interesting thing, actually maybe that's not working, is if you look at the ratio of semiconductor performance to energy performance, energy typically should follow semiconductors because it's a risk-on trade, it's a global economy trade, but energy is actually lagging. So one of the questions we have to ask is which one of the sectors is right here, which one is wrong? I think semiconductors are right. This global economy is recovering, and energy has got some catching up to do.
And as far as, just to broaden it out, the expectations for this reporting season are so low that you think it's going to surprise on the upside?
They're extremely low. I mean, look, we've had these conversations many times, and analysts do cut their earnings into the reporting season. But this time, the expectations are down 7.2%, which is double the typical 3.5–4% cut to earnings revisions. So I do think that the bar is set low. And then you have to vary a little bit by sector. I'm going to come back to energy, because energy estimates were cut by 30%. In this particular quarter. So the bar for energy is set exceptionally low. And in fact, the average energy stock is pricing in oil price of around $50 a barrel. The strip is about 61, the 12-month strip. So there's definitely some value to be had there.
Okay, Jeff, you like old tech more than the FANGs of the world, and you like energy.
Yeah, I do. I absolutely agree with Anastasia, who I've actually met with at J.P. Morgan a couple times. Energy is being priced at about the same valuation metrics as it was when crude oil was trading at 26 bucks a barrel. I think the stocks are cheap. My dad, that was a portfolio manager, used to tell me good things tend to happen to cheap stocks. So I like the energies. I agree with her a lot. I like the energy sector a lot.
And old tech too, right?
Yeah, I do like old tech. Old tech has actually done very well since the late December low that we identified following our October 2nd trader sell signal.
And 3,100 on the S&P by the end of the year. And you have not been shy or bashful about being bullish on your previous appearances.
No, I mean, you know, if you think it's going up, be bullish. If you think it's going down, be bearish. But for gosh sakes, make a call, because there's too many people on Wall Street that talk out of both sides of their mouths. So no matter what the equity markets do, they can say, see, I told you that was going to happen.
So you watch
the show. And if you make calls, Joe, you're going to be wrong. So the trick is to be wrong quickly for a de minimis loss of capital.
3,000 near term on the S&P. And most people say we're 20, a lot of people, Jeff, and you know, some of the people you're talking about, but they say 2,900, we've probably seen the best levels, but then it goes to 3,000, and they'll say 3,000 probably end here, and then 3,100, they'll say 3,100 is fair. You know, that's what we see. But a lot of people are not nearly as bullish as they were at the beginning of 2018 for some reason. They got, I don't know, they got scared in December of last year, I think.
Yeah, they weren't listening to the message of the market in early October, which clearly flashed a sell signal on a short-term trading basis. But longer term, secular bull markets last 15-plus years. We'll call 10 years into it. This thing ought to have another 5, 6, 7 years left in it, and hardly anybody believes it.
Do you have a target like that, Anastasia?
We do have a 3,000 target on the S&P, and I think the upside, there's upside risk to it, more so than the downside risk. The reason being is that the same thing that really made the market reaction so pronounced back in December to the downside, the same thing could actually drive it here to the upside. If you look at the average hedge fund positioning, it is still pretty low when it comes to equity beta. If you look at investors, they have been selling this equity rally, and that's one of the things that actually keeps us constructive on the market, is that data is improving, policy is supportive, and investors are likely to get pulled into the market here. So there's a technical aspect of it. As you get certain triggers, certain moving averages get triggered, investors will have to step in, especially as volatility is so low. And then fundamentally, you get a better PMI print, you get better China data, then fundamental investors will be forced to step in as well.
I want to go to what you think will work within something that is not working, and healthcare is definitely not working. The worst performing sector on the S&P 500 just went negative for the year in yesterday's session. But within healthcare, you've identified a subsector that you like.
That's right. Probably one of the most promising, one of the most compelling trends within healthcare at the moment is the area of gene therapy. And this is the potential to cure previously uncurable diseases, not just having the lifelong treatment. So we're talking about things like sickle cell disease, cystic fibrosis, muscular dystrophy, and even cancer. Certain cell therapies can actually treat and successfully cure a cancer. So yesterday, for example, the healthcare sector was selling off some of the gene therapy biotech names that we monitor how we're selling off as well. I think that is very much overdone because the issues that we have within healthcare policy revolve around Medicare for all, which would not directly impact these names, or they revolve around drug pricing, which is more really going after the larger scale produced drugs and not so much about these niche therapies, many of which are not even yet approved anyway.